Why are fixed indexed annuities the hottest thing going on the market right now? Well, because there are a lot of baby boomers who are getting ready for retirement, and they remember what it was like during the dot-com crash and during the 2008 financial crisis. Let's take a look. While the stock market may average 8 to 10% over the long term, it doesn't go up at 8% consistently every year. Instead, it's very, very volatile. So you can have periods of tremendous growth and people start to feel comfortable and start counting their chickens before they hatch. And then those gains end up getting wiped out by tremendous periods of loss, like what happened in the dot-com crash. And then the market starts to recover, and then they get wiped out again, like what happened in the 2008 financial crisis. And people are smart enough to realize that we're near all-time market highs. Do they really want to take the risk of losing all those gains that they've accumulated over the last 10 years? And it's been more than 10 years since a major market correction and a prolonged recession. Is it possible that we're due for one? Bear markets occur every 5 years, so you might say that we're overdue for one. The average decline is 39%. The average duration is 1.5 years, and the average time to break even is 5.2 years. And people don't realize the math behind the compounding losses. What's the break-even point after a market loss? Well, if you lose 10%, you need to make 11.2 just to break even. If you lose 25%, you need to make 33% just to break even. If you lose 45 or 50%, you need to make somewhere between 82% to 100% just to get back to even. But what if we could take that risk off the table, lock in your profits, and put it in a program that was still going to give you tremendous growth, much better than just letting your money sit and rot in the bank? After you see this, you're going to consider this a Christmas present. Here's a real client account, and I'm going to show you the performance on this account. We've got 1/3 of this money invested in a BlackRock fund, 1/3 of the money in a fund managed by Fidelity, and 1/3 of the money in an S&P multi-asset risk control. Let's check out the historical performance. The lowest 10-year period this allocation has ever returned was a 6.5% rate of return, 5.6% net after fees. The highest 10-year period this allocation has ever done was 10.23% or 9.28% net after fees. And the most recent 10-year period, 8.6% or 7.6% net after fees. Imagine having a program like this as part of your retirement plan. How much more confident would you be with all of the financial choices that you had to make?